Good morning, everyone. Welcome to this exclusive webinar organized by Standard Chartered Bank. At the onset, on behalf of the bank, I would like to thank you all for joining in, and we look forward for your participation. Today's webinar is focused on the Union Budget, which was tabled last Saturday. What are the key takeaways from the budget? Is there a particular segment of the market which benefits from the budget? Any sectors which are standing out? Does it warrant a relook at your investments? These and many more questions would be on your mind, and we hope to answer your queries during the next 1 hour. And who better than Mr. Navneet Munnot to join us? Navneet Munnot joined SBI Funds Management as the Chief Investment Officer in December 2008. He has over 24 years of experience in the financial markets. In his role, Navneet is responsible for overseeing investments worth over USD 53 billion across various asset classes in mutual funds and segregated accounts. In previous assignment, he was the Executive Director and Head Multi-Investment Management at Morgan Stanley Investment Management. Prior to joining Morgan Stanley, he was the Chief Investment Officer, Fixed Income Hybrid Funds at Birla Sun Life Mutual Fund. Navneet is the Chairman of the Indian Association of Investment Professionals. He is the nominee director on the board of SBI Pension Funds and is widely respected for his views in my financial markets. He's a chartered accountant, a holder of CFA institutes, CAI Institute, and has also done FRM. Thank you, Navneet, for taking time and joining us. And over to you for your quick takeaways before we open it to the audience for questions.
Sure, I'll be very brief because a lot has already been said about the budget. It was the longest speech, if not one of the longest, as well as a lot of analysis has already happened. I'm sure everybody knows about what has been announced in the budget. If we look at the backdrop in which this budget got presented, it couldn't have been tougher than this. The growth has moderated very sharply, both at the real growth level as well as the nominal GDP growth is the lowest since 2002-03, and we have to go back to maybe 1975-76 for a nominal GDP growth of around 7.5%. The inflation has inched up recently, which makes it tougher for RBI to cut rates further. The tax revenues have been sluggish. On the other side, the government expenditure, a large part of it is very sticky. So if you look at the salaries, pensions, defense, some of the subsidies, interest payment, etc. But at the same time, large number of sectors are asking for some or the other fiscal boost. So whether it's the real estate, whether it's the NBFCs, whether it's the auto sector, whether the rural economy, everybody has been looking forward to some boost from the fiscal side, but there was very limited fiscal space available. Finance Minister ended up choosing the 50 basis point leeway that was available in the FRBM, so the deficit came a little higher. Whether that will make the bond investors happy, my sense is that the bond market was already pricing in a deficit on these lines. There is not going to be additional borrowing this year, and that's why the bond yields have come down by 10 basis point or so today. But if I have to look at some of the bigger ideas in the budget, I think one is, and which have not been talked much, a lot of other things have been talked a lot more, so I wouldn't touch upon that, but few things which haven't been talked as much. One, I think, is a lot of focus on import substitution, though not much time was devoted in the budget speech to that. But if you look at the number of items on which custom duty has been increased, and a very substantial increase that has been made, clearly targeted towards a lot more make in India and import substitution. Now longer term, one can argue if that's the right way to do it, or invest a lot more in innovation and productivity gains, but at least in the near term that can help the Indian industry, the domestic manufacturers. The other idea is to attract a lot more foreign savings. So whether the tax-free treatment for sovereign wealth funds, if they are investing in infrastructure, higher limits for FPIs in participation in corporate bond market, continuity of lower withholding tax for FPIs, the dividend tax, the dividend distribution tax repeal. The biggest beneficiaries will actually be the multinationals as well as the FPIs and some of these pension funds and sovereign wealth funds. I can go on. There have been a couple of more measures which are clearly targeted towards attracting a lot much more foreign investment, because the domestic domestic savings pool is limited. The other is, I think, on the agricultural side and the rural side, that I think the agri exports can become a very, very big focus area over the next few years. India has a lot of potential. Our productivity is very low. Using technology, better means of irrigation and variety of other measures that got announced, whether to boost the warehousing, whether to boost the the agri markets, etc. I think can go a long way in boosting the agri exports. The other thing is the GST Council is a great example of how center and states can work together. In India, we pay a lot more attention to the union budget. I mean, almost everybody in the country is watching the union budget. But if I tell you that the state governments put together have almost a 40% bigger budget than the central government budget. That's where the real action is. Also, most of the central government schemes ultimately gets delivered by the state government or the local governments. The capital expenditure done by the central government is almost half of what is done by state governments in India, and nobody discusses the state government budgets. And also, so they have to work together. GST Council was a great example of how center and state can work together. I think in the area of land, in the area of labor, in the area of power, in the area of agriculture, I think there were clear indications that the government wants to replicate that model of GST Council, where center and state work together for better delivery of every government service. I think that was one of the highlights. The other, I think, the very big and bold move is LIC listing. I think it's also an optic or the a signal that government is willing to privatize or to divest any of the public sector unit. I mean, LIC is like one of the last holy cow that one would assume government would never go for listing. I think that was a very bold move, and also saying that IDBI will ultimately be privatized. That could be a beginning of maybe bigger reforms in the public sector space. I think that again will lead to, over a period of time, not only the revenue maximization for the government by selling the assets and the monetization of their assets, but also a significant improvement in governance of the public sector. Now, the market got disappointed for, I'm sure everybody knows about it, the long-term capital gain tax. There were a lot of expectations which got belied. Also, I think sector-specific measures on sectors like real estate, on some of the other consumer and industrial sectors which have been going through a challenging time. We did not see as much action on some of those fronts. And also there's a little bit of confusion on the personal income tax, etc. I'm sure over the next few days the government will come with a lot more clarifications on that. The one last point I would like to make is there are a lot of things that happens outside the budget. Of course, everybody pays so much attention on that day. A big reform like corporate tax cut happened, I mean, much ahead of the budget. They could have waited for the budget. Similarly, many things can happen after the announcement of this budget. So it's not that one single day everything has to be announced. Okay, it was a good blueprint, but I think going forward we have to see how the execution happens on those intentions, and also what more can be announced in the next few days.
Thank you, Navneet. We have quite a few flood of questions already, so I think we'll take one by one. The first few questions are a lot on the taxation part itself. Most of our investors are still worried, is PPF still interest exempt on will it continue to have that benefit? And the other one is on this whole TDS and dividend. How do you see it playing out, because the dividend has gone to the investor,
to the investor. Yeah.
So in the mutual fund space now, how do you all do that?
So taking the second question first, I think in the mutual fund space, the SWP, the systematic withdrawal plan, may become more attractive instead of taking dividend, particularly for those who are in a high tax bracket. Makes sense to probably move towards a short-term capital gain tax or a long-term capital gain tax, and move towards the systematic withdrawal plan. On the PPF, etc. So I mean, if you continue to remain in the older regime, then I think all the PPF and the other benefits that were available to you in Section 80C and some of the other exemptions that continue. But clearly the government's intention seems to be that over a period of time these exemptions will be withdrawn. They will move towards a more simplified regime where you know that if I'm making 7 lakh and then I pay this much amount, I'm in tax. You don't have to calculate various other exemptions and deductions. One can argue whether that's good over a longer period of time or not, because there are some other objectives that get achieved through these exemptions. For example, India has shortage of domestic savings that come in financial markets, and that's why any incentive to promote financial savings, whether in the form of mutual fund, NPS, insurance, or provident fund, etc., helps in meeting our investment needs. And I think any move which kind of impacts that growth of financial saving can also have negative repercussion. But I'm sure between simplification on one side versus some of the other objectives that get achieved, it's a tough balancing act.
Yeah. So one question is specifically on the marine sector. So taking that itself, sectorally, do you see which sectors do you think could benefit from the budget, or where is the focus of the government going? Infra, as you said, is a big thing, and that's why they need to raise a lot of funds. So they have tried to ease limits for FI. So according to sectors, where do you think where the government's focus is, and where if they're missed, which they could do outside the budget?
Sure. So I think in the near term, the growth will be driven by this rural sector. One, that we had a good monsoon. The sowing season has gone extremely well. If we track the sowing pattern across the country, and we are seeing that crop is likely to be good. Food prices have moved up, and on top of that, with PM Kisan and some of the other measures taken by the government, both by the center as well as state, if money reaches the rural area, that could be an interesting space to look at. While on the infrastructure, the government's capex is not going up very substantially. Of course, this year the government's the YOY capex of the central government will be higher. We have to wait and watch how the state governments play, because in some of the state governments, things like loan waiver, etc., take away the ability of state governments to spend more on the capex. Our view is that the investment cycle has bottomed. We are going to see a revival in the investment cycle going forward, driven by both government expenditure as well as the private capex. The measures like allowing sovereign wealth fund to buy infrastructure assets and then not pay tax over a period of time. You will see NHAI selling road assets, you will see transmission assets, power assets, and a lot of other infra assets getting sold. Private sector investment in the railways that has been talked about. All of this augur well for the infrastructure sector. So quality companies within the capital goods, engineering, construction, where balance sheet is in a good shape, execution capability is good, and I think over a period as the cycle revives and over a period of time, we also believe that private sector will also start investing after some time, because the benefit that has been given in the form of lower corporate tax rate, and now dividend distribution tax has also gone. So you've kept more money in the hand of corporates, which logically over a period of time should help in it for them to invest a little more. So I think that should do well. The immediate negative, the markets have reacted negatively to the insurance sector, clearly because the ATC benefit. But when we do our math, what we are finding, and this is what the companies are telling us, that 85% of their flows are from people who are not looking at the ATC benefits. It's a genuine investment that they are making, or maybe the life cover that they are taking. And as it is over a period of time, our idea is that protection business should grow, not so much. I mean, insurance should not be sold as a savings product. But at least in the near term, I mean, there is a little bit of negative. They have also got impacted negatively on dividend distribution tax front. But by and large, is there a sector that stands out in terms of something big bang in budget, or something that has got very negatively impacted? I'm not very sure of that. Yeah. There are a lot of expectations on real estate, if I can repeat that what I mentioned earlier. Because real estate is one sector which can help driving growth in a very big way. It has a huge multiplier effect. In fact, I would argue that the liquidity tightness that everybody talks about across the country, across all businesses that I meet, people talk about liquidity nahi hai. There's less of money. And I think one of the reasons is the money is stuck in the real estate. The activity in real estate increases the velocity of money also over a period of time. And I think a lot of businesses who are stuck, the personal investments in the real estate, using the working capital and all of that, over a period of time, I think if we revive the real estate, it creates job, it has a lot of multiplier effect. In fact, the tax revenues on account of GST, etc., improves for the government. So I was expecting a lot more on real estate than what has come, and I expect, as you asked, that what we can expect, I hope that more measures are taken on that front.
So one interesting question here is, given that the government in the new regime is trying to move away from the standard deduction and ATC, you answered the question on insurance that you don't see that much of an impact.
Maybe there could be a little bit of impact in the near term, but then business models will evolve.
Evolve.
Companies will, yeah.
Can this help consumption? Because there's been a lot of with more liquid money or more investments now. The consumer has the money. It's up to him whether he spends or saves it. So will this help revive consumption, which has
maybe the millennials will opt for the new regime and would like to spend this money rather than saving it. But I would argue that whether it's good for the country in the long run, I'm not very sure. But I think we need both. I think we need a good fine balancing between these two. India needs to save a lot more than what we are doing, particularly the financial savings. I think because we don't have a defined social security, people are a lot more dependent on their own investments over a long period of time. So I hope that some incentives continue for people to invest for long term.
So some questions are from senior citizens. I think they're getting very worried with this ATC deductions because they used to benefit a lot. One is, I think, is on exemption of PPF interest. That still remains, right? With
As of now, yes. I think if you continue in the old regime, everything continues. There is no, as far as I know, there is some 43 pages of like fine print that you have to read over and above the long budget speech. But as far as I know, I think if you remain in the older regime, then there is no change for you. All the exemptions and deductions which are available under various sections, that continue. Only if you opt for lower rate and a simplified regime, then only you have to look at those exemptions.
So there is one question here, which is better of the regimes, the old or new?
I think, I think Finance Minister mentioned that you may not need an advisor, but I think as of now, for next 1 year, you need an advisor to calculate under both the regimes.
There's a question, for SME sector is a big there we have seen certain challenges. Do you see that beyond the budget itself, even there's been some improvement in indicators if you track for the SME sectors? And because one of the biggest problems they faced was the funding. They were very linked to the NBFCs. There, are you seeing some improvement?
That's what I mentioned. I think the real estate, NBFCs, HFCs, a little bit of more was expected from the budget. But as I mentioned, there was one scheme for reviving the stall project in real estate, and the securitization of NBFC got announced a few months back. There could be more in the pipeline, I hope. But for the SMEs in particular, I think as the economy starts recovering from where we are today, and I think they had to adjust to lots of changes in the economy, including the GST and before that demonetization, because of a lot of other changes that have happened in the economy and the policy regime. They are adjusting towards a new normal. And then there are so many technological disruptions or digital disruptions that they are dealing with, getting competition from a different set of players like the e-commerce, etc. I think over a period of time, as the economy starts recovering, the businesses also start adjusting themselves to the new reality, new tax regime, new policy regime, etc. And liquidity, RBI has pumped in a lot of liquidity in last few months, but somehow so at a macro level there is a lot of liquidity in the banking system. At micro level, people are not witnessing it yet, but at some point in time you'll see the flow through happening and the transmission happening, and you will see a lower rates getting transmitted to the SMEs and MSME. Clearly, there is a move that how do we improve the credit flow to the SME, MSME sector. There is this new platform for factoring. There is a new platform for, there are a variety of measures that the government is looking at to support the credit flow towards the SME. But I think for the bigger thing is when the growth gets revived, I think that will be a bigger positive for them.
So there's questions on real estate. Maybe I'll turn it around because you said there were not that many measures. What measures would you like in the real estate sectors which can help improve the sentiment beyond the budget, even from the government or RBI? What would you be looking so that that segment starts a bit of a revival?
So I think what the industry was demanding, maybe a higher tax incentive for buying the house, but on the contrary, the government's intention seems to be removing all the exemptions, but people were thinking that there could be a one-time higher exemption on account of interest that you pay on home loans. That could have led to, let's say, a buying coming in from new home buyers if they were looking at a new incentive to them. Maybe I think increasing the scope of what is today called an affordable housing in terms of size and the value of that, increasing the flow of credit from the banking system to them. There is a fund that the government has launched for reviving the stalled projects. If that can be made a lot more simplified and a little bolder to increase the credit flow to the real estate sector. And I think both center as well as state governments have to work together. If there could be some incentives on, let's say, stamp duty, etc. If you're buying a house in next 3 months or 6 months, I think that can also go a long way. The real estate, again, I repeat maybe second or third time, is very critical for reviving the overall economy. I think we underestimate the multiplier effect of the real estate sector. Yeah.
So coming now, so from sector, the questions on how do you see the market going ahead? Which particular, especially this is primarily on equity, which particular segment do you think could benefit? We've seen a big rally in few large caps. Will that broaden? Is there from a risk reward, is mid and small cap better? Also, there are questions on the global risk. There were things that it was improving now with the coronavirus outbreak. Do you see risk also there coming in, filtering in earnings in India?
Okay. So yeah, as far as budget is concerned, the event is behind us.
Yes.
Going forward, what market would be looking at is corporate earnings. Market would be looking at execution of whatever has got announced in the budget, and of course the global environment, which in last few days has become a little hazy because of this whole outbreak of the coronavirus. I'm sure everybody would know Chinese market opened today after a couple of days and they are down like 7 or 8%. There are a lot of fears around spread of the coronavirus. We'll have to wait and watch how it evolves over a period of time. From India's perspective, there is a negative and there is a positive. Talking about the global market, and then I come to domestic. The negative aspect is that if it impacts the global growth, then it will surely be negative for India also, because as I mentioned earlier, government is trying to boost the export, etc., and our ability will be limited. The positive aspect could be this slowdown in growth will keep commodity prices under check. We have already seen crude oil prices coming down, and this will also lead to central banks printing a lot of money. Because there is an environment of uncertainty globally, to counter that, and growth is coming down, at least there are fears of growth coming down, central banks will try to err on the side of caution. They will cut rates, they will print more money, so global liquidity can increase, and if India can attract a little bit of that liquidity, that will be positive for India. Coming to India, I think next few months, what is more critical is the corporate earnings, how they evolve, and also the execution by the government, as we have been discussing for last few minutes. In terms of the overall direction of the market between large cap and mid and small cap, last few months our view has been that the rally is going to get more broad based. In last 2 years, right since I would say beginning of 2018, we have seen a narrow set of stocks, particularly within the large cap space, which have been doing very well, while large part of the market has not participated in the rally. But clearly in last 2 months we are seeing the rally getting broad based. In fact, if you look at the month of January, where Nifty and Sensex were down, but mid and small cap indices were up like 5, 7, 8%, depending on which index you are looking at. So there are clear signs that rally is getting more broad based. Our view is that in terms of economic recovery, there is going to be a slow and steady recovery. There is going to be a slow and steady recovery in corporate earnings, which will reflect in slow and steady recovery across market capitalization.
On the earnings recovery part itself, because this is one thesis which has been going on for many years now. There was an expected boost post the corporate tax cut. But that also is supposedly benefiting more of the larger cap space. When do you see do you think that the fundamentals now, with the likely, as you said, rural possibility of a rural revival, that the broader market earnings also could, rather than those 10-15 stocks, you could see in the broader market earnings revival in the coming quarters?
I think so, unless this global situation deteriorates because of this coronavirus and it spreads much more than what it is anticipated today, and situation becomes uncertain. But on the domestic front, I think the growth recovery will become more broad based. We have seen slowdown in consumption, investment cycle was already very low, exports have not been growing for last several years. I think we are going to see recovery on all of these fronts, and I think over a period of time, if there is a recovery in the economy, I'm sure a larger number of sectors will benefit, unlike what we have seen in last 2 years, where there have been a few handful of stocks that have done well. As I mentioned earlier, that we believe rural economy is likely to benefit from whatever has happened, including a good monsoon and good sowing and whatever soaps that the government is giving. That will help in revival of consumption, and that will help in recovery of a couple of other sectors. In terms of corporate earnings growth, big driver will be the financials, where some of the large corporate lenders who have been providing for NPAs and have brought down the overall earnings at the aggregate level. Now that large part of the NPA provisioning is behind us, as you get a more normalized credit growth and then credit costs, I think they will drive the growth. Then a couple of other sectors, look at telecom. I mean, they have been posting large amount of losses, but it looks like that situation is coming to a bottom. Next few years, I think they could create a large pool of profits, and that's true. If the investment cycle gets revived, then the entire industrial space can also do the same. So we believe that it's going to be a little more broad based than what we have seen in last few years.
So this question is a little different, more on tourism can be a big,
absolutely,
not only economic generator, huge employment. Are we lacking a structural focus on that particular sector? Because even in the budget speech there was, but when you see the amount of money which is allocated, it doesn't seem matching there. That could be a big, not only for employment, also to propel growth.
Again, I'll go back to my previous point where I mentioned that we always look at the central government's budget, but on some of those things have to be done at the local level. I think over a period of time, the combination of Swachh Bharat, the Clean India, combination of like better infrastructure if we create, the sheer appeal that India has in terms of offering itself to various kinds of visitors from the world. It's a pity that India gets less number of tourists than countries like Thailand or Turkey or Indonesia. I mean, even a Bali gets more than a country like India. I think there's a lot of potential, and it was heartening to see some mention about how to recover some of those archaeological sites, starting new trains and some of those things. But as I mentioned, I think state governments will have to do a lot more there. Yeah. Each state, if they can identify few of these, like we have this Buddha circuit, or maybe there could be variety of those things that can be identified. In fact, if you ask me, more than manufacturing, which everybody believes is the answer to employment generation, my strong view in India is going to be services. It's going to be tourism, it's going to be education, it's going to be healthcare. It's going to be some of those kind of things which are going to be a bigger generator of employment than manufacturing.
So there's a question on sectors itself. So now if you are looking at a 1 to 3 year horizon, which sectors do you think will lead the growth beyond the budget, even on corporate earnings? And is there any sectors which we should be a little bit more cautious on?
I think it should be a lot more bottom-up stock picking within each sector rather than a big sectoral call I would give. Though earlier I mentioned that pockets of financials, I mean pockets of banks, because of the advantage they have on the liability side, I think they will do well as credit growth goes up, as the credit cost come down, because the NPAs have already been provided for. I think banks would be a beneficiary. The industrial space that I mentioned, if investment cycle revives, they would be a beneficiary. If rural economy starts showing results, then maybe pockets of consumption, particularly on the discretionary side, will start showing results. Also, I think maybe some of the other dark horse, if one has to talk about, maybe the public sector units. I think the stocks have got beaten down very significantly. Some of these sectors have also been in trouble last few years, but if government remains determined for a strategic divestment, then there could be a re-rating of some of the public sector units. Maybe I'm just thinking aloud, don't have a strong view, but maybe pharma has underperformed very significantly last few years, and the risk reward could be favorable. So I mean, I'll maybe again repeat the same point that in last few years we have seen just handful of those stocks doing well. I think the rally becomes more broad based.
So one question is on the markets itself. You've answered that. Why hasn't it responded positively? What people have ignored also to some, not ignored, the bond and currency markets were closed.
Yeah.
The budget looks a little bit more positive for the bond markets. What's your takeaways on that?
I would say neutral, because market was quite fearful till Friday that what's the gross and net borrowing number going to be, and whether government would splurge money to get growth back and ignore the bond market. That didn't come true. The overall gross and net borrowing numbers came in line with the market expectations, and market went a little light ahead of the budget announcement because people, I think in the bond market there were a lot of fears about the government borrowing. So that's why today the bond yields are down by around 10 basis point. And also I think the measures to get more foreign portfolio investors money will also help the bond market. My sense is that bond yields are likely to remain range bound. The recent uptick in the inflation and the kind of fiscal deficit we have now, RBI has very limited room for cutting interest rates now. What RBI will do is things like Operation Twist, which they have been doing. To explain it, buying long-term bonds and selling short-term bonds so that long-term bond yields come down. And that's what they have been trying to do. Maybe some of those measures to ensure that bond yields don't go up. But I think the overall borrowing is so large now, and the financial savings pool in India is not as large. So I think the yields are likely to remain range bound.
So given the question on yields itself, we have RBI policy also coming up this week. There's a question, is there an outside chance now of some time down that you could have a rate hike?
Not in the near term. Not in the near term. Simply because you look at India's growth. I mean, should we continue growing at 4.5-5%? I think our potential growth rate is much higher than where we are growing, and I think RBI would keep that in mind. Of course, the inflation has shot up recently, but that's more driven by the seasonal factors. Some of the agri commodity prices have gone up. Also, a little bit because there is a upward revision in telecom prices, which will also have impact on the CPI, etc. But I think RBI would keep the growth in mind while taking a call on the interest rates. I don't think that in the very near term we are going to see a rate hike. No.
And also, the INR has been very resilient in this entire, even with the global risk compared to other EM currencies, it's been quite resilient. We continue to get that level of flows which is there. So what's your view? We should see this resilience of the INR continuing?
Because the flows have been very strong. If you look at last 12 months, FIs have invested like $16-17 billion in equity. This is despite all the uncertainty pertaining to the slowdown in growth and some of the other challenges we have seen in the corporate and banking and the financial sector. The foreign investors have continued to keep a lot of faith in the Indian equities. The current account deficit has been well controlled. Oil prices recently have come off. I mean, they went up and then they have come down again. So overall situation on the current account has been well under control. RBI has built up huge foreign exchange reserves in last few quarters. They are at a record high now. Looking at all of that, the currency is likely to remain stable. The one point we have to keep in mind is what happens in China, because the Chinese currency, I think if that depreciates because of what's happening in China today, foreigners sell Chinese markets, and if in that case, India will also have to depreciate, because that will have an implication on all the EM currencies, and India may also have to depreciate. Barring that, I think we are going to be a range-bound currency.
So there's a lot of questions on the dividend distribution tax. How does it now impact equity and debt because it comes to the investor? Does it impact liquid and arbitrage funds because those used to be used on that aspect? And more interestingly, there's a question, PSUs were very heavy dividend paying companies. Will this trigger a bit of a sell-off in those because now I, as an investor, have to end up paying much more the tax? So could it trigger a sell-off in the PSU shares, which is
but to that extent, the PSU would be paying higher dividend. Of course, it depends on which income bracket you are, where that dividend would be taxable. But think about from an institutional perspective, mutual fund doesn't have to pay tax on dividend receipts from a public sector or from any company. So a high dividend yielding company from that perspective becomes attractive for institutional investors, including a foreign portfolio investor, not so much for an individual investor. I'm just thinking aloud that I think for individual investors now, actually mutual funds will become even more attractive. Because if you're buying any security and let's say particularly in the stock market, if you're buying a stock and getting a dividend income, I mean, it's going to tax at a much higher level while keeping the money in an equity fund. And if you are in growth option, I mean, you don't pay tax till the time you get a long-term capital gain, or even a short-term capital gain tax is much lower than the tax rate in your own hands. So that's, I think, becomes more attractive. From the debt perspective, I think more and more people will now look at the systematic withdrawal plan than the dividend option.
Uh, there's a question on the, so broadly, one is this deposit insurance has been increased, so that could be positive
Yeah.
for at least people putting more deposits in that. Taking that broader question more, there was nothing on the NBFCs in the budget. Where are we in the credit cycle according to you? Are we, is the bottom made? It's a slow recovery. RBI has announced different measures. Government have tried to address the problems, but we still had Vodafone Idea recently. So, where are we according to you in the credit cycle right now?
So, I mean, you rightly mentioned that there were more expectations on NBFCs, HFCs, and also, as I mentioned again, to repeat the same point, that real estate is closely linked with the challenges that we have witnessed in the NBFC, HFC sector. Good part is that some of these recent measures by the RBI, where the supervision of the regulatory powers of RBI, of HFCs have moved to Reserve Bank. There is now a resolution mechanism which is in place, which wasn't the case earlier. So if there is a bankruptcy in an NBFC or HFC, we didn't have a proper framework in place, but now we have seen that there is a framework in place. They can be referred to IBC. Some of these measures are good, and also I think there are measures to improve the securitization market, co-lending space, etc. Market is clearly differentiating now. The stronger NBFCs and HFCs with good promoters, with good balance sheet, with good ALM, etc., and then the asset quality. I think there the spreads have come down very significantly. For some of the other HFCs and NBFCs, the spreads have not come down, and that's why I think expectations were there that both central government and RBI would do a little more to help the, I would say, the weaker NBFCs and HFCs.
There are a few more questions on sectors itself. So one person saying there's a lot of reforms in farming sector which they've announced.
Absolutely.
And to your thesis, so is that going to be the sector which we can watch out for, and how do we play in as an equity investor or debt investor? There's not much themes in that to play perspective.
So normally people look at the agri inputs, I mean all kinds of inputs that agriculture uses, that's one of the way. But the other way is that helps in a broader recovery in consumption. And if the farmer's income increases, if rural incomes increase, I think it helps the broader consumption theme. That's another way to play. The other thing you talked about was on the, one is the agri and second is?
So second one is actually they're asking on exports. So there was not many soaps in the budget on the exports, but what take, because if the rupee has to be a bit stable, we need an export recovery, and exports were quite downbeat.
Absolutely.
Last year. So do you see likely a
So not the last year, in fact last 7 years, in 2012, India's exports, if I remember correctly, were a little over $300 billion. Will be like $320 billion. For 7 years, India's exports in dollar terms have not grown. And in this period, we have seen a significant increase in exports by smaller countries like Vietnam, Bangladesh, I mean even Cambodia and Malaysia and Thailand. I mean all of those countries have benefited. I think that what government has been trying to do over the last few quarters is, whether it's the decrease in the corporate tax rate for new units, whether it's promoting the more electronics manufacturing in India, whether this import substitution that we talked about as one of the theme in this budget, and some of the other measures in the exports by way of what the Commerce Ministry is doing to get some bilateral deals, etc., are done with several countries. There is a clear intention that we need a boost to the exports. One of the things that we talked about is the agri exports, where India has a lot of potential which has been underutilized. The other actually is the import substitute.
Agri is a sort of a sensitive topic, right? Because certain products, when you export too much, then when there is an inflation spurt, we have an issue of...
So I think we need a lot more policy certainty and predictability on that front. Another interesting thing that not much attention has been paid, what government is doing to identify each district as a cluster for a particular export. So let's say certain utensils or some handicraft in Muradabad, or let's say what Jaipur can do, or what let's say Tirupur can do, or what a Ludhiana can do. Identify those, and then the local government, state government, and the central government works together in a focused manner. This is what China has done beautifully. Of course, at a much bigger scale in terms of SEZ and all, India will take time, but at least we can identify a few areas. In fact, I was seeing this morning a big ad of thanking government by the textile industry because the duty on PTA import has been brought down, which is an input for the textile guys. So clearly they are looking at few industries where India can regain its competitiveness.
So there's some questions on the energy sector, oil marketing, gas sector. What's your view on that beyond the budget? Even is that segment, because we've seen Brent also as oil prices have fallen a bit in the recent past.
Yeah, so I mean, generally that's positive for the oil companies, but I think the bigger trigger would be the divestment of BPCL. I think that's something that everybody needs to watch out for. If you are able to do a strategic divestment of BPCL, and that opens up the door for the strategic divestment of some of the other oil companies, then they can get re-rated.
Uh,
Yes, another interesting thing that though in budget there were few mentions about at least a recognition of the problem that we have on the environmental side on climate change, and whether you look at the quality of air, the quality of water, and for that we need to do a lot of work on energy sector, and have to over a period of time move to a different sources and different way of producing and consuming energy. And over a period of time, that could also be a very interesting sector in terms of incremental investments. The entire energy infrastructure has to undergo a massive change if we have to cope up with the climate change. The challenges that we have seen in Delhi, and even I think BKC is incidentally one of the most polluted places in the country.
Yeah. So coming back to markets now, if budget is behind, RBI policy more or less no surprises are expected.
Unlikely.
How do you see? So what would be your equity outlook and your debt outlook? Is there a particular segment where you think a little bit more exposure should be taken and take advantage in case you have a pullback also because of the coronavirus scare which is there? Do you think that more of a short term, because when we look at SARS also it had a short term blip, but then and there's been some positive development over the weekend also, some cases have got solved, so it might be getting a little bit curve. So what's the overall market outlook for this year?
So before the outbreak of coronavirus, till few weeks back, the general expectation was that global economy has been, I mean, it is likely to witness a bit of recovery driven by the stimulus in China. Given the election year in US, I think the government would ensure that policies are favorable for businesses and the market. Central banks would continue to print a lot of money and ensure that, that there are no major mishaps. I think with all of that has undergone a little bit of change because of the coronavirus. But if history is any guide, if you go back and remember the 2003 when SARS outbreak happened, unless this time is different and it completely blows out of proportion, history is that after 2 or 3 months things starts stabilizing. In fact, when the summer comes, I mean, some of the challenges will get sorted out. The virus itself gets self-killing. If that happens, then I think we are going to get support from this ample global liquidity and slow and steady recovery in India, driven by, as I mentioned, rural recovery, a little bit of revival in the investment cycle, little bit of revival on the exports front, and RBI, as I mentioned, is keeping a lot of liquidity here while it has not transmitted fully in lower rates for everybody, but it will ultimately happen. With all of those things, if the growth becomes more broad-based, earnings recovery becomes more broad-based, then market rally should also become broad-based. And that's why I would argue in favor of, let's say, a multi-cap kind of fund where you have an ability to participate across market capitalization and across market themes. There could be interesting pockets of opportunities in several sectors, and where in whichever fund where you can participate across all of them would be a good choice.
And on the debt side, there also we've seen a lot of rally in more of the in like the real true AAA segment. People have been very risk averse in that. Do you see credit now a little bit of exposure in that segment, or you continue to prefer the short maturity, the banking PSU, where everyone is, the flows have gone a lot in corporate bond market.
So I would repeat the words of the wise words of Warren Buffett: be greedy when everybody is fearful. Be fearful when everybody is greedy. So 2 or 3 years back, everybody was very greedy. People were looking at which fund has got the highest YTM, yield to maturity, and this fund must be would be delivering the best returns. And today, as you said, the other way around. People are putting money in funds where there is the lowest YTM because that would have the lowest risk in the portfolio. I think now the risk rewards are in favor if you take credit risk. So I would argue in favor of, let's say, credit risk fund or any other category where, I mean, a very, I would say, measured risk is taken on the credit front because the AAA spreads have come down, but the spreads at the AA and A level are still quite elevated because of this environment of investors being very risk averse, and money is not flowing into credit funds. Money is flowing into those banking and PSU funds or the corporate bond funds where investments are made in high quality AAA. So those spreads have come down along with the liquidity. I think that there is bit of opportunity over the next few years in the credit space.
And how about duration? Because though as you said, the budget was neutral. Neutral would be a little bit more positive for the bond market. But as we go into, the one thing which is not noticed by a lot of people is one is of the state budgets, but also the state budgets are tracking back on their revenues. So could we have higher borrowings of state budget hitting the market, which could keep the yield curve still there? And where does RBI's operation twist, because that could result in short-term yields moving up
little bit, not much, because what they are doing is keeping ample liquidity in the banking system. Today, like more than 2 lakh crores of liquidity in the banking system, which banks are giving to RBI on a daily basis. And there's a kind of liquidity which is there. The operation twist is trying, if we can, so let's say the policy rate is 5.15. But the 10-year bond was trading at 6.6% on Friday. There is a big gap between 5.15 and 6.6. And then if you look at other bonds of state governments or the other AAA, etc., then there is even more higher spread. How do you bring down that spread? So whatever you have done on the policy side, cutting 135 basis points last year, how it can reflect in lower lending rates and lower bond yields. So Operation Twist was targeted towards that, and our sense is that RBI would continue on that path. Whether there could be a significant decline in interest rates from here on, I'm not very sure. I think rates are going to be range bound simply because the sheer amount of borrowing that you talked about, central government, state governments, and then a lot of public sector units. The Food Corporation of India is a large borrower in the market because government is not paying the full food subsidy to the Food Corporation of India. And ultimately it all comes to chase the same savings pool that we have in India. Maybe foreigners become very bullish on Indian bond market. We get a lot of money from them. I think the yields can come down. Another positive, though, I was surprised. I don't know whether there was a mention about it, but the government is trying to get India's bonds into global bond indices. If India's bond gets included in global bond index, then a lot of flows can come to India. Just like we are part of an MSCI emerging market index or MSCI global index on the equity side, and a lot of passive money comes to India on the equity side, can we get the same money on the bond side? That can help. I would still think that maybe rates are going to be range bound, and I think a combination of duration and accrual with something like, let's say, a medium term opportunity fund or a credit risk fund would be able to capture that bit of duration gain and also get the credit risk premiums which are pretty attractive now.
One of the last questions which is there is on, we've seen the RBI is flushed with liquidity, the system is flushed with liquidity, but credit growth is at abnormally multi-year low. And if we take out few segments, it's actually negative. Credit is not there. When is that? Because usually you see, obviously there is some lag, but after a point you do see that credit going into the system. But this time the lag seems very long.
Very long,
So what's your views on that? Will that credit flow into the system? Because then only can we talk of a more sustainable growth recovery also going ahead.
No, absolutely. So availability of credit is very important. I mean, credit is the lifeline of business or lifeline of the economy. Over the last few years, we have seen credit growing even lower than the nominal GDP growth. There has to be a multiplier for 100 rupee of GDP growth, you need more than 100 rupees of credit creation. But for variety of reasons, because corporates were deleveraging, banks were providing for NPAs, large part of the PSU banking system, which was in PCA, the slack was taken by some of the private sector banks and the NBFCs, HFCs. Now, NBFCs, HFCs came into trouble post the ILFS default in September 2018. And then if the investment cycle is not reviving, if there are no large projects to lend to, and the earlier lending to the corporate sector which the banking system had done, now let's say whether it's the, I won't take the names, but let's say steel sector, power sector and all, so now they are going out of your balance sheet. So then the overall at an aggregate level, you see a lower growth on the credit side. But I think once the banks have already done that, the retail credit has been growing pretty well. I mean, in fact, if you see within the credit growth, the personal loans are growing very fast. Credit card loans are growing fast. The mortgages are growing fast. Loan against property growing fast. It's the corporate credit which has not been growing, or the business credit to the manufacturing sector, industrial sector. But if our view is right that we are going to see a slow and steady recovery in the economy driven by the investment cycle recovery, then I think we are going to see higher credit growth as well going forward.
And just before we end, any risks which we should be materially worried about, or we should keep in track for the next year or so, other than the coronavirus?
No, as of now, coronavirus is very unpredictable. Nobody really knows which way it's going to play out. As of now, people are going back and seeing what happened in 2003, if I remember the year correctly, on SARS outbreak and the impact that it had on global economy, global markets, etc. But I mean, you don't know. I mean, it could be different this time. So that's a bit of uncertainty. There's an election year in US,
Yes.
and things can. I mean, we saw what happened between US and Iran, and maybe some of that geopolitical risk that we have to keep in mind, because we are a large oil importer. So anything that happens in Middle East should always be kept in mind. From a domestic perspective, I think it depends on how government executes and the how sentiments get revived from the business community perspective. Earnings is the most critical thing for the equity market. While we can discuss all of these macro, but ultimately the stock price is nothing but the slave of the earning power of the underlying company. So if you see the earning growth, the rest of the things would get taken care of. If earning growth is not there, then everything else that happens on macro will not be as relevant.
Thank you so much, Navneet,
Pleasure.
for joining us in this webinar. I'm sure our clients' queries have been addressed. In case you still have queries, please contact your investment advisor. At the end of this webinar, there will be a feedback form. Please give your feedback form, and in case you have, as mentioned, any queries or questions, reach out to your relationship manager and investment advisor, and we'll be happy to help you. Thank you all for taking time, and hopefully this was a fruitful webinar. Thank you. Have a good day.